Most traders lose money on the 15-minute chart because they chase breakouts. The price breaks a key level, they jump in, and then bam, it reverses right back on them. In this video I am going to show you a professional 15-minute breakout retest strategy that helps you avoid those nasty fakeouts and enter with much better timing and way smaller risk. This isn't just theory, it's a step-by-step system you can start using today. I'll also give you some powerful fake breakout filters and tell you the best trading sessions to apply this strategy. This is beginner-friendly, but it's also powerful enough for advanced traders looking to refine their edge. Let's get into it. First things first, let's set up our chart. Open your 15-minute chart for any major forex pair or a liquid crypto coin. This strategy works best on assets with high volume, so avoid those low-volume, choppy markets. Now, add just one indicator. The 50 PREA exponential moving average, or 50 IMA. We also want to have our volume indicator visible at the bottom of the screen. And finally, we'll be drawing our own horizontal support and resistance lines. A quick but important note, we use the 50 IMA only as a trend filter. If the price is above it, we're generally looking for buys. If it's below, we're looking for sells. We are not using it for entries. A clean chart is a profitable chart. Now for the most important step, identifying key levels. Step 1 is to mark clean, obvious support and resistance zones on your chart. What makes a level clean? Second, these reaction zones should be distinct, not buried and messy, sideways chop. And third, a very important confirmation step. Switch to the 1-hour time frame. The level should also be clearly visible and respected there. This higher time frame confirmation is crucial. Remember, strong levels create strong breakouts. Weak, messy levels create weak, fake breakouts. So take your time with this step. It's the foundation of the entire strategy. Once you have your key levels marked, we wait for the breakout. But not just any breakout will do. A valid breakout candle must have a few key characteristics. First, it needs a large body, showing strong momentum. Second, it must close clearly outside the level, not just poke through with a wick. And finally, the breakout needs to happen during an active trading session, like the London or New York Open. If the breakout candle is small and weak, or if there's no volume spike, just skip it. It's likely a trap. This next part is where most traders make their biggest mistake. They enter right on the breakout candle, chasing the price. We don't do that. We wait for the retest. This is where the professionals enter. Here's the buy setup. A resistance level breaks. At that level, we look for a bullish rejection candle to form. A pin bar or an engulfing candle are perfect examples. We enter our buy trade at the close of that rejection candle. For a sell setup, it's the exact opposite. Support breaks, the price pulls back up to the level, which now acts as resistance. We look for a bearish rejection candle and enter our sell at its close. Patience during the retest phase separates the amateurs from the pros. Now let's talk about protecting our capital with a smart stop loss. Your stop loss should not be placed right at the support or resistance level. Instead, it goes just beyond the rejection candle that confirmed your entry. For a sell trade, place your stop just above the high of the bearish rejection candle. Why do we do this? This simple technique protects you from the normal market noise and price wiggles that can happen around key levels. It gives your trade the breathing room it needs to work out without getting stopped out prematurely. Okay, you're in the trade. Your stop is set. Where do you take profit? There are 3 simple methods you can use. Method 1 is using a fixed risk to reward ratio. For this intraday strategy, aim for a minimum of 1-to-2. So if you're risking 20 pips, your target should be at least 40 pips away. Method 2 is to target the next key support or resistance level on your chart. This is often the most logical place for price to head next. Method 3 is called a range projection. You measure the height of the trading range that the price broke out from, and then project that distance from the breakout point to set your target. The key with intraday trading is not to get greedy. Take your structured targets and be happy with consistent wins. Now, let's cover some incredibly important filters that will help you avoid fake breakouts. Seriously, this part alone can dramatically increase your win rate. You should skip a trade if any of these conditions are met. First, if the breakout happens during low volume hours, like the Asian session or late US session, be very cautious. Second, if a level has already been tested 5 or more times, it might be getting weak and ready to fail. Third, if the breakout candle itself is small and weak, it's a red flag. Fifth, if you're trying to buy a breakout but the trend on the higher time frame is clearly down, you're fighting a losing battle. And finally, never take a breakout trade right before a major news announcement. Volatility can get crazy. The best sessions for this strategy are the London Open, the New York Open, and especially the London-New York overlap, which is typically the most active part of the trading day. You want to avoid trading during the late US session as volume dies down. And definitely avoid the weekend crypto chop if you're a crypto trader, as price action can be unpredictable. Trading during holidays is also generally a bad idea. Stick to the prime time, and you'll find much cleaner setups. Let's walk through a quick example. Here on the chart, we can see the price respected this resistance level 3 different times. Then, a strong, large-bodied breakout candle forms, closing well above the level. And look at the volume bar below, it's significantly higher than average. Instead of chasing that green candle, we practice patience and wait. Sure enough, the price pulls back to our old resistance level. Right at the level, it forms a beautiful bullish engulfing candle, signaling that buyers are stepping back in. Our entry is at the close of this candle. Our stop loss goes just below the low of the engulfing candle. For our profit target, we identify the next clear resistance level higher up, which gives us a fantastic 2.3 to 1 risk to reward ratio. A perfect textbook trade. That is why it is essential that you only risk a small percentage of your account on any single trade, ideally 1% or less. This strategy builds its edge over a large series of trades, not on one single home run. Protect your capital, follow the rules, and let the probabilities play out in your favor over time. If you found this breakdown helpful and want more professional trading strategies, make sure to hit that subscribe button and turn on notifications so you don't miss the next video. Thanks for watching, and I'll see you in the next one.